I've heard this idea whispered in bucket shops and shouted across social media. Trading is always profitable. Always. As if the market owes a man a living just because he shows up with a chart and a dream. I've spent enough years watching price tape to tell you that notion has ruined more traders than bad information ever did. You ever notice how the loudest promises come from people who've never sat through a real drawdown? When I first learned to read the market, I wasn't chasing profit every day, I was chasing understanding. The market doesn't pay wages, it pays for being right, and it charges interest for being wrong. If you walk in expecting a steady paycheck, you're already at odds with how price behaves. Trends don't unfold on your schedule. They form, hesitate, reverse, and sometimes they do nothing at all. What do you do on those days? Force a trade just to feel productive. A man who believes trading must always be profitable starts pressing when he shouldn't. He trades out of boredom, not conviction. He sees a few candles move and calls it opportunity, even when the market is telling him to stand aside. I learned early that sitting still is a position. Does your chart ever tell you to do nothing, and do you listen when it does? Losses aren't mistakes by default. They're the cost of doing business. The real mistake is refusing to accept them. I've watched traders hold a losing position because they couldn't stand the idea of being wrong. They told themselves it would come back. The market doesn't care what you tell yourself. Price only knows supply and demand, and it moves when it's ready. Have you ever noticed how the hardest loss is the one you should have taken quickly? The belief in constant profit poisons risk management. If you think every trade should win, you'll size too big. You'll stop respecting your stops. You'll widen them just a little, then a little more, because surely this trade can't lose too. That's how one bad idea turns into a ruined account. I never tried to be right all the time. I tried to lose small when I was wrong. Isn't it strange how survival matters more than brilliance in this game? Charts don't reward optimism. They reward patience. A clean breakout doesn't need your hope. It needs confirmation. Volume, structure, time. Those are the things that matter. When a stock doesn't act right, I step away. I don't argue with it. The market is never wrong, but opinions often are. How many times have you blamed the market instead of questioning your timing? People talk about winning streaks like they're proof of skill. They aren't. They're just periods when the market aligns with your method. The dangerous part is what comes after. Confidence turns into certainty, and certainty blinds you. You start believing you've cracked some permanent code. That's when the market humbles you. Have you ever felt invincible right before a losing run? A trader's mindset isn't about believing in endless profit. It's about believing in discipline. I waited for my pitch. I didn't swing at everything. When the market was dull, I protected my capital. When it showed its hand, I pressed, but only then. Wealth in trading doesn't come from constant action. It comes from selective aggression. Do you know the difference between being active and being effective? The charts are a record of human behavior. Fear leaves marks. Greed leaves marks. You can see them if you stop projecting your wishes onto the screen. Unreal expectations make traders deaf to those signals. They see what they want, not what is. A true speculator studies price like a doctor studies symptoms. He doesn't promise a cure every day, he diagnoses before he acts. Are you treating your charts like evidence or like encouragement? Money management is where the fantasy of always profitable finally collapses. If you risk too much, one loss erases 10 good trades. If you risk too little, you never grow. The balance isn't emotional, it's mathematical. I sized my trades so I could survive being wrong multiple times in a row. Can you say the same about your last setup? The edge works over time, not on demand. That's a sentence most traders nod at, and then quietly ignore the moment real money is on the line. They understand it with their heads, but not with their accounts. Because the minute a trade doesn't move in their favor, they start demanding results, as if the market signed a contract with them. Have you ever noticed how patience disappears right after you place an order? An edge isn't a lucky pattern or a clever indicator. It's a tendency, nothing more. A tendency for price to behave a certain way under certain conditions. And tendencies don't show up on command. They show up when they're ready. You can't rush them, and you can't negotiate with them. Yet traders keep acting like every setup deserves an immediate payoff. If your method worked on demand, wouldn't everyone be rich by now? Time is the part of trading most people underestimate. They think time means waiting a few minutes or a few candles. Real time is measured in dozens of trades, sometimes hundreds. Your edge doesn't prove itself in a single position. It proves itself across a series, where losses are absorbed and gains are allowed to do their work. That's uncomfortable, because it requires sitting through uncertainty without flinching. How comfortable are you with not knowing when the payoff comes? The demand for instant confirmation is what breaks good traders. They enter a sound trade, then watch every tick like it owes them an explanation. The moment price hesitates, doubt creeps in. They start adjusting stops, second-guessing entries, bailing out early. Not because the chart changed, but because their expectations did. Do you really trust your edge, or only when it agrees with you quickly? Markets move in cycles, and edges breathe within those cycles. There are periods when conditions are perfect, when your setups appear clean and follow through with ease. Then there are stretches when nothing works quite right. The same pattern that paid last month chops you up this month. That doesn't mean the edge is gone. It means the environment shifted. The trader who understands this adjusts exposure, not beliefs. Do you adapt your size when conditions change, or do you keep swinging the same way? An edge demands discipline more than intelligence. Anyone can spot a pattern in hindsight. The hard part is executing it consistently when recent results have been discouraging. That's where most traders abandon their method. Right before it would have paid them back, they confuse temporary discomfort with permanent failure. Have you ever quit on a strategy just before it started working again? The idea of on demand. Profits turns trading into an emotional tug of war. One win feels like validation, one loss feels like betrayal. That emotional volatility leads to inconsistency. You trade bigger after wins, smaller after losses, constantly changing the rules. But an edge only works when it's applied the same way every time. Probability doesn't care about your last trade. Why should your next decision? Risk is the bridge between edge and time. If you risk too much, time never gets a chance to work. One bad stretch wipes you out before the math can assert itself. If you risk appropriately, you survive long enough for the probabilities to unfold. That's not exciting. It doesn't make for dramatic stories. But it's the difference between a trader and a gambler. Are you structuring your risk for longevity or for adrenaline? Charts don't announce when the edge is about to assert itself. They don't ring a bell before a run of winners. They look ordinary right up until they aren't. That's why consistency matters. You must be in the game, trading your plan, when the conditions finally align. Miss a few trades because you're discouraged, and you miss the very move that makes the month. How many times have you been flat when your setup finally worked? The edge working over time also means accepting boredom. Most of trading is waiting for price to come to your level, waiting for confirmation, waiting for the series to play out. People who need constant stimulation sabotage their own edge. They add trades that don't belong just to feel involved. But the market pays for restraint, not restlessness. Can you sit quietly while nothing happens? I never tried to force the market to reward me. I focused on behaving correctly while the market did whatever it pleased. When my edge was out of favor, I traded smaller. When it was in sync, I pressed. I didn't ask it to work today or tomorrow. I trusted it to work eventually as long as I respected it. That trust wasn't blind faith. It was earned through records, repetition, and scars. The trader who understands time stops reacting to every outcome. A loss becomes a data point, not a verdict. A win becomes confirmation, not permission to get reckless. Over enough trades, the noise fades and the structure emerges. That's when you see whether you truly have an edge or just a string of coincidences. Are you keeping records long enough to know the difference? Demanding results on demand turns trading into a test of ego. Letting the edge work over time turns it into a profession. One is exhausting, the other sustainable. The market will always tempt you to rush to prove something, to extract money before it's ready to give it. And every time you give in to that temptation, you step outside the edge you claim to trust. Because in the end, the edge doesn't care how badly you want it to work today. It only responds to patience, consistency, and time, and most traders run out of those long before the edge ever gets the chance to show itself. Losses are not failures, they are operating expenses. That idea sounds simple until real money is on the line. Then it feels personal. A losing trade doesn't just take dollars from an account, it challenges a trader's self-image. The problem is that the market never asked you to tie your identity to your P&L. You did that yourself. Have you ever noticed how calm you are before entering a trade, and how emotional you become the moment it goes against you? Every business has costs. A store pays rent whether customers show up or not. A manufacturer pays for raw materials knowing some will be wasted. Trading is no different, except the expense is called a loss, and it shows up immediately. Traders who don't accept this treat every loss as proof they don't belong in the market. But the market doesn't judge belonging. It only reacts to orders. Why should a losing trade mean more than what it is? A cost of participation. The man who can't accept losses has no future in speculation. I learned that the hard way. Early on, I tried to avoid losses entirely. I tightened stops too much, exited good trades too early, and hesitated when it mattered. I wasn't trading price, I was trading fear. Losses kept showing up anyway, just in different forms. Have you ever tried to dodge losses so hard that you ended up sabotaging good trades? A loss taken correctly is not a mistake. It's confirmation that your risk control is working. When price violates your premise, you step aside. That's not weakness. That's professionalism. The failure comes when you refuse to accept the expense and let it compound. One unmanaged loss has a way of inviting another. Before long, you're no longer trading your method. You're defending your pride. How often has pride cost you more than the original loss? The belief that losses equal failure pushes traders into revenge trading. They try to earn back what was lost, not because the chart offers opportunity, but because their emotions demand balance. That's like doubling your business expenses just because last month was slow. The market doesn't reward urgency. It punishes it. Have you ever entered a trade you didn't plan, just to make yourself feel whole again? Operating expenses are predictable over time. Losses show up in every edge, every method, every market. The difference between a losing trader and a profitable one isn't the absence of losses. It's how those losses are handled. The profitable trader plans for them. He sizes positions knowing some will fail. He doesn't argue with the bill when it arrives. Do you budget your losses, or do they always come as a shock? Charts don't promise smooth equity curves. They promise opportunity mixed with disappointment. Trends fail. Breakouts trap. Support breaks when it shouldn't. None of that is personal. It's the nature of price discovery. When you accept that, losses stop feeling like judgment and start feeling like information. Information tells you whether conditions favor your approach or not. Are you listening to what your losses are trying to teach you? The trader who fears losses avoids taking trades altogether. He waits for certainty that never comes. By the time he feels safe, the move is over. In trying to avoid the expense, he misses the revenue. That's not discipline. That's paralysis. Trading requires action under uncertainty. Losses are the toll you pay for the chance to participate. Would you expect to reach your destination without paying the toll? There's also a quiet confidence that comes from accepting losses. When you know the worst case outcome in advance, fear loses its grip. You stop flinching at every tick. You let trades breathe because you're not emotionally attached to being right. That calm shows up in your execution. It shows up in your patience. It shows up in your results. Have you noticed how much clearer charts look when you're not afraid of losing? Operating expenses must be kept small. That's the part many traders miss. Accepting losses doesn't mean tolerating large ones. It means cutting them quickly and consistently. Small losses keep you in the game. Large losses remove you from it. I never cared about being right. I cared about staying solvent. The market gives endless opportunities, but only to those who survive long enough to see them. A trader who respects losses respects capital. Capital is the tool, not the scorecard. Once you treat capital like something to be protected instead of something to be proven, your behavior changes. You stop forcing trades. You stop increasing size out of frustration. You stop measuring your worth by your last trade. Isn't it strange how discipline improves the moment ego steps aside? Losses also reveal character. They show whether a trader follows rules when it hurts. Anyone can trade well after a win. The real test comes after a loss, when doubt whispers that the rules don't work. That's when consistency matters most. If you change your approach every time you lose, you'll never know whether it had an edge in the first place. Are you evaluating your method, or reacting to your emotions? The market charges tuition. Some pay it slowly, others pay it all at once. Those who learn to see losses as operating expenses tend to stay enrolled long enough to graduate. Those who see them as personal failures usually quit before the lesson sinks in. Trading doesn't require perfection. It requires endurance, discipline, and respect for risk, and those qualities are forged through losses, not wins. When you stop fearing losses, you stop rushing profits. You allow winners to develop. You give trends time to mature. That's when the business starts to make sense. Expenses come in regularly, revenue comes in unevenly, and over time, if the edge is real, the balance shifts in your favor. But only if you're still there to collect it. Trading skill is revealed during drawdowns, not profits. Profits are generous storytellers. They make everyone sound smart. They smooth over bad habits and reward mistakes just long enough to confuse you. A rising equity curve can hide a lot of ignorance. But a drawdown strips a trader bare. That's when the market stops flattering you and starts asking questions. And the only answers that count are the ones expressed through behavior. Have you ever noticed how confident traders sound right after a winning streak? Anyone can look disciplined when trades are working. Stops feel easy to respect when price never comes near them. Patience feels natural when the market trends cleanly in your direction. But none of that proves skill. It only proves alignment. The real examination begins when alignment disappears, when setups fail, when breakouts stall, when the market takes back what it gave. That's when a trader shows whether he understands risk or merely enjoyed momentum. How do you behave when the market stops cooperating? Drawdowns test belief, not strategy. The method you trusted yesterday suddenly feels fragile. Every loss whispers that maybe the edge is gone, maybe it never existed. The temptation is to tweak, adjust, optimize, anything to escape discomfort. But constant change during a drawdown is usually a confession of insecurity. Skill is staying consistent long enough to gather real evidence. Are you evaluating your system or trying to silence doubt? The first thing a drawdown exposes is position sizing. When size is wrong, drawdowns feel unbearable. Losses feel heavier than they should. Fear shows up early and stays late. That's not the market's fault. That's leverage revealing itself. A skilled trader feels pressure during a drawdown, but not panic. Panic means risk was misjudged long before the losing streak began. Does your drawdown feel uncomfortable or intolerable? Emotional control isn't proven by calm during wins. It's proven by restraint during losses. The urge to trade more, trade faster, trade bigger. That urge grows loud in a drawdown. The market hasn't changed, but your internal dialogue has. Skill is recognizing that voice and not obeying it. Most traders don't blow up on bad analysis. They blow up trying to escape pain. Have you ever taken a trade just to feel relief? Drawdowns also reveal whether a trader respects probability. If you truly understand that losses cluster, then a losing streak doesn't shock you. It doesn't trigger a crisis of confidence. It's unpleasant, but it's expected. Traders who expect smooth results are the ones most shaken when reality intervenes. Skill is accepting variance without abandoning structure. Do you intellectually accept probability or emotionally reject it? Charts look different during drawdowns, not because price changed, but because perception did. Every pullback feels threatening. Every hesitation looks like failure. That's when discipline matters most. A skilled trader reads the chart the same way regardless of recent results. He doesn't tighten stops out of fear or loosen them out of hope. He follows the same process because the process, not the outcome, is what's being tested. Can you read price without projecting your recent pain onto it? Record keeping becomes invaluable during drawdowns, not as comfort but as clarity. The skilled trader looks at statistics, not feelings. He checks whether losses fall within expected parameters. He reviews execution, not just outcomes. He asks whether rules were followed, not whether money was made. An unskilled trader avoids records during drawdowns because the truth feels heavy. Which one do you become when results turn against you? Patience is another trait exposed by drawdowns. When profits slow, impatience accelerates. Traders start forcing setups, lowering standards, convincing themselves that mediocre trades are close enough. That's erosion, not adaptation. Skill is maintaining selectivity when opportunities seem scarce. The market eventually offers clarity again, but only to those who didn't exhaust their capital and confidence chasing noise. Do you lower your standards when you're frustrated? There's also humility in a well-handled drawdown. The skilled trader doesn't declare war on the market. He doesn't claim it's manipulated or broken. He accepts that his approach is temporarily out of sync and adjusts exposure accordingly. Smaller size, fewer trades, same rules. That humility preserves both capital and clarity. Ego, on the other hand, tries to dominate the drawdown, and ego always pays extra tuition. Drawdowns reveal whether a trader understands survival as a goal. Winning traders think in terms of staying power. They know that 1 month doesn't define a career. They protect themselves from catastrophic damage because they intend to be around for the next opportunity. Traders without skill measure success too narrowly. They want immediate validation, and when they don't get it, they press. How far ahead are you really thinking? Confidence during a drawdown isn't loud. It's quiet. It shows up as routine. Same preparation, same execution, same review process. No dramatic changes, no emotional declarations, just work. That kind of confidence isn't borrowed from recent profits. It's built from repetition and understanding. It doesn't eliminate discomfort, but it keeps discomfort from dictating decisions. Does your routine survive stress? The market doesn't reward desperation. It waits it out. Traders reveal themselves by how long they can endure uncertainty without self-destructing. A drawdown is the market asking, do you know who you are without validation? Many traders don't. They confuse success with self-worth, and when profits vanish, so does discipline. Skill is separating identity from outcome. Every trader will face drawdowns. There are no exceptions. The only variable is how they're handled. Some traders come out sharper, more refined, more respectful of risk. Others come out damaged, reckless, or gone. The difference isn't intelligence, it's behavior under pressure. That's why drawdowns are the true exam. The market never agreed to pay you daily wages. That misunderstanding sits at the root of most trading pain. People come into this business carrying expectations borrowed from regular work. You show up, you put in effort, you expect compensation. But the market doesn't recognize effort. It doesn't track hours spent watching charts or nights lost thinking about setups. It only responds to timing, risk, and behavior. Have you ever caught yourself feeling entitled to a green day just because you were disciplined yesterday? A paycheck mindset turns trading into a daily emotional negotiation. If you make money today, you feel competent. If you don't, you feel cheated. That's a dangerous way to interact with price. The market isn't your employer, and it doesn't owe consistency. It offers opportunity in bursts, not installments. When traders expect daily income, they force trades on quiet days and overtrade on bad ones. Do you trade because the chart calls for it, or because the calendar does? There are days when the market simply doesn't move in a way that pays your method. On those days, the correct action is restraint. But a trader expecting wages sees restraint as failure. Sitting flat feels unproductive, even though it may be the most professional choice available. That impatience leads to low, quality entries and unnecessary risk. Have you ever looked back at a losing day and realized the best trade was no trade at all? The wage expectation also distorts risk perception. When you believe money should come in regularly, losses feel unacceptable. A single red day feels like a broken promise. That emotional pressure leads traders to widen stops, hold losers, and avoid taking small losses that are part of the game. They start managing emotions instead of positions. Does your risk plan change depending on how your week is going? Trading income is uneven by nature. Profits often come clustered. One good trend can pay for weeks of inactivity, but that requires patience and the ability to sit through dry spells without losing composure. Traders who demand daily rewards rarely stay disciplined long enough to catch the moves that matter. They're too busy chasing crumbs. Are you built to wait for the feast, or do you keep grabbing at snacks? Charts don't distribute money evenly. They compress opportunity into moments. Breakouts don't happen on schedule. Reversals don't wait for your bills. The market moves when supply and demand shift, not when you're ready, accepting that reality changes everything. You stop measuring success by daily P&L and start measuring it by execution quality. How often do you judge a good day by how well you followed your rules instead of how much you made? The daily wage illusion also fuels overconfidence after small wins. A few green days in a row can trick a trader into thinking they've found a steady income stream. Size creeps up, standards slip. The market eventually reminds them that consistency in trading is earned over time, not assumed. Those who mistake a lucky streak for a salary usually give it all back. Have you ever increased size just because recent days felt easy? Professional traders think in terms of campaigns, not shifts. They wait for conditions that favor their approach, then commit capital with purpose. They don't need the market to pay them today, because they're focused on being positioned when it matters. That long view reduces emotional noise. It turns trading into decision-making rather than income chasing. Do you plan your trades like a campaign or like a workday? There's freedom in letting go of the wage mindset. Once you accept that some days will be quiet, you stop forcing activity. You conserve mental energy. You protect capital. You approach the market with curiosity instead of need. That shift alone improves performance, because need clouds judgment. The market can sense desperation through poor decisions. Can you tell the difference between opportunity and urgency? Daily wage thinking also leads to unnecessary complexity. Traders add indicators, strategies, and time frames to manufacture trades when none exist. They mistake activity for progress. In reality, simplicity thrives when patience is allowed. A clean chart and a clear plan outperform frantic analysis every time. Have you noticed how messy your charts get when you're trying to make something happen? When the market finally does offer opportunity, it rarely announces itself loudly. It rewards those who are ready, rested, and disciplined. Traders exhausted from daily battling often miss these moments. They're emotionally spent or overexposed. The wage mindset drains you before the real work begins. Would you rather be tired from overtrading or fresh when the market finally moves? The idea that the market should pay you regularly is comforting, but it's false. Comfort and truth rarely travel together in trading. The sooner you accept irregular income, the sooner you trade in harmony with price instead of against it. You stop asking what the market will give you today and start asking what it's showing you now. That question leads to better trades and fewer regrets. A trader who releases entitlement becomes adaptable. He's not anchored to daily results, so he can adjust size, stand aside, or wait without emotional backlash. That adaptability is a quiet advantage. It keeps you solvent and sane while others burn out chasing consistency that doesn't exist. In the long run, the market rewards those who respect its nature, not those who try to turn it into a paycheck machine.